So you have worldwide income, maybe from Germany, China, or wherever, and you need to do US taxes. Or maybe your spouse has worldwide income or doesn't even have a social security number or tax identification number. What do you do in order to get the best benefits for you and your spouse so that you can have the lowest tax liability? Let's talk about it. If you happen to be single or just want to get to the tax credits that I'm going to talk about, then you can skip to this timestamp below, and that will be when I talk about the foreign earned income exclusion and the foreign tax credit and which one to choose. First things first, you have the option of either filing married separately or to file married jointly. If you file married separately, then you don't include your spouse's income at all, and you don't have to worry about the worldwide income. But if you elect to file married jointly, then you have to report your spouse's income into your own income. Or if you happen to make income outside of the US, then you also need to report that income. Because the United States and like 3 other countries are the only countries that tax worldwide income, even if you didn't make it in the US, which I think is kind of stupid, but it helps the US generate more revenue even if you didn't earn it in the United States. Some other considerations are that if you want to marry file jointly, you can get a higher standard deduction, meaning that you'll have less tax liability. Moreover, if you are married and you want to apply for Obamacare or subsidies for cheaper health insurance through the marketplace, you need to file married jointly most of the time in order to get those premium tax credits and cheaper health insurance. Moreover, you want to consider the different credits that you might be eligible for in order to decrease your tax liability. So there are 2 main ways that you can do that, which I'm going to speak about. There is the foreign earned income exclusion, which is better for countries with very low or no income taxes, so that you basically shield up to $112,000 from US taxation. Well, that's how much it was in 2022. There's also the foreign tax credit, which will basically, if you paid $100 in income taxes to Germany, for example, then you can not pay $100 to the United States. So let's go over an example. Let's say you're married. If you're single, then the same logic applies, so just pay attention. So if you're married and you're making $140,000, if all that income of $140,000 was made in the United States, or you happen to not claim any tax credits, you would have to pay $16,336 in income taxes on a federal level, not to mention the state level. And here's a little tax bracket for those who are married filing jointly. So it can be anywhere from 10 to 37%. And if you happen to be single, the taxes are a little bit higher depending on how much income you make. But if you claim the foreign earned income exclusion, then you'll only be taxed on a $28,000 of taxable income instead of the original $140,000. And that would be $210. So you basically save about $16,000 by claiming the foreign earned income exclusion. There's also the foreign tax credit. So this is better for countries that tax a lot more. So you lower your US taxes by the amount you pay to another country. If you paid Germany, I don't know, $20,000, then you can offset whatever your US tax liability is by $20,000. However, this credit is non-refundable. So even if you pay the US only $1,000, the extra $19,000 difference, you don't get back as a refund. So the foreign earned income exclusion and the foreign tax credit can both be claimed, but you can't claim it on the same dollar of income. As an example, if you had $140,000 in worldwide income and $112,000 was your foreign earned income exclusion, you have $28,000 remaining of taxable income. But let's say you paid a country called Bailey a 10% tax of $14,000. Well, $28,000 over $140,000, the remaining taxable income that you have, is only 20%. Thus, you can only claim as part of the foreign tax credit 20% of the $14,000 you paid to Bailey's country, meaning you have $2,800 left of tax that you can offset on your US taxes. So if we go back to the example before, it was $16,336, then we knocked off $16,126, leaving only $210 left in federal income taxes. Well, that $210 is subtracted by your partial foreign tax credit of $2,800, and thus your tax liability is $0. So this was an example of how you can stack the foreign earned income exclusion, and the foreign tax credit in order to get the lowest tax liability. And this is better than just claiming the foreign tax credit because you only paid $14,000 to Bailey's country, while you would have paid like $16,000 to the US, leaving you with $2,000 or so in tax liability. But by stacking it together like this, you're able to get the lowest tax liability. However, the foreign tax credit is super easy to achieve. All you need is foreign worldwide income, and then you can get the foreign tax credit. However, if you want to claim the foreign earned income exclusion, there are very strict requirements. So there's the physical presence test or the bona fide residence test. In order to qualify for the foreign earned income exclusion, you need to be physically located outside the US for 330 days during a 12-month period, and you need to establish your tax home in that foreign country. So you have to actually live and work in the foreign country and be there for at least 330 days. There's also the bona fide residence test, where you are a resident of the foreign country for an uninterrupted period that covers an entire tax year, and you also have to establish your foreign tax home. But if you need more time in order to qualify for the credit, you can apply for Form 2350, which is the application for extension of time to file your U.S. income tax return for citizens and resident aliens abroad who expect to qualify for special tax treatment. So a tax home is where you live and work. So you have to have a job or live in the foreign country. That means that if you have a home in the United States, you need to rent it out. If you have a car, you need to put it in storage or sell it. If you have pets, you need to take it to the foreign country. You have to actually establish as your tax home a foreign country. Moreover, if you happen to be outside of the country on April 15th, which is the tax deadline, most cases, you receive an automatic extension for 2 months until June 15th. But if you need a longer extension in order to qualify for the foreign earned income exclusion, you need to request the additional extension using the Form 2350. So say you moved to a foreign country on June 30th, 2020. So you landed and you were physically in the country or in the airspace on June 30th at 4 p.m. Well, that doesn't count as a day because you weren't there for the full 24 hours. So you were actually there starting July 1st, 2020. And then waiting 330 days, you get to May 27th, 2021. So you can claim a partial exclusion after May 27th, 2021 for the tax year 2020, which would be about 50%. And you can just go into Google and type in 330 days after July 1st, 2020. And then that's how I got May 27th, 2021, if you were curious. And then I just typed in how many days of year is July 1st, 2021. So here is 182nd day. Since July 1st, 2020 is the 182nd day of the year, you just do 366 minus 182 and divide all that by 366 to get your ratio of exclusion. Remember, 2020 is a leap year, so that's why it's 366 days instead of 365 days. And then in 2020, the foreign earned income exclusion was $107,600. It increases every single year, so times that by your exclusion ratio, and that's $54,122.80 that you can exclude from your 2020 taxable income. Also, just as an FYI, international waters do not count, so you have to be in another country's airspace, not in international waters, like on a cruise, for example. So when you physically land, and then it needs to be, again, 330 days in a 12-month period. However, the 330 days doesn't need to be consecutive or in the same country. So if you were out of the country in 2 different countries for 330 days in a 12-month period, you would still get the foreign earned income exclusion. And then if you move to the country on July 1st, you can do like a partial exclusion. This just goes to show you need to consider your own situation for what is best, but for a lot of people, it will be the foreign earned income exclusion and then stacked with the foreign tax credit. But if you don't qualify for the foreign earned income exclusion, you have to elect the foreign tax credit. And one of the cheapest softwares I found to do that, if you don't want to hire and get expensive accountants, is TaxAct. So I put a referral link in the description below for 20% off if you so choose to do it. In 2022, the TaxAct Deluxe package is the one that worked, and with the discount, it's $21.36 for the federal return, which includes the Form 2555 for the foreign earned income exclusion. The state return has an additional cost, but TaxAct is the one that I found to be the least expensive option. One other note, if you are married and your spouse does not have a social security number or tax identification number, then you can still fill out the tax stuff online, but in the social security number box, just leave that empty or just put a fake one, because you're gonna have to mark it out anyway, and you're gonna have to attach some other documentation that I'm going to go over soon. You have to do this because you can't file electronically. Instead, you have to mail it in. So you have to print it out and then physically in the mail it in, because your spouse does not have a tax identification number. Let's go over an example where you as a US resident or a US citizen have to file taxes, but you want to include your spouse as part of your tax return by filing married jointly. Well, your spouse, who is a non-resident, doesn't have a tax identification number, doesn't have a social security number, but you want to attach them because they don't make that much income, or you want to include them so that you can get a higher standard deduction or other tax benefits, or you want to apply for Obamacare because apparently you have to file your taxes married jointly in order to qualify for the cheaper health insurance through the premium tax credits and lower health insurance. So if you want to do that, you need to include a statement saying that your non-resident spouse and you as the U.S. citizen want to be treated both as U.S. residents for the entire tax year so that you can file married jointly. The template of which is included below. You can include your name, address, and then your identification number, so your social security number, and then your non-resident spouse's identification number, along with their passport or other documentation proving their non-residency. Moreover, you need to apply for Form W-7. Form W-7 is an application for an IRS individual tax identification number because your spouse needs that number in order to do their tax return. So using TaxAct or Free Tax USA or any tax software of your choice, just leave the social security number blank, or just write 0000000, or just write a fake social security number and then print it out and delete the social security number part for your spouse because they don't have one yet, and then attach your written statement saying that you both want to be treated as U.S. residents, which the template is below, and then include Form W-7 and follow those instructions and fill out that form so that your non-resident spouse can get a tax identification number, and then attach documentation, probably a foreign passport, so that you can marry filing jointly. This is a real headache, and I had to do this for my aunt because her husband lives in China and has some income, and I wanted to help my aunt out, who is currently living in the US, to get a lower tax liability and Obamacare. So that's why I did it. But make sure to do your own research, because once you make the election, you can only undo it once. So let's say there's a divorce or a death of a spouse, then either one of you can revoke the election by writing another statement, but just note that this can only be done once. So once you revoke this election, you can never elect to marry file jointly again because you revoked the election. It's a one-time deal. And remember that if you are married, even if it's to a non-resident spouse, you only have the option to either marry file jointly or marry file separately, or head of household if you have dependents. But you can't choose a single status because you are no longer single. And remember, if you are filing married jointly, then you have to include your spouse's worldwide income into your tax return, but with the higher standard deduction and other tax benefits like the foreign tax credits I spoke about, it might be worth it. But remember, you have to do your own research and decide for yourself depending on your situation. Make sure that you file both the federal and state return if you have to do a state return as well. Good luck. Hope this helped in handling your worldwide income or your non-resident spouse. It was very tedious for me to help my aunt because there was so much to consider. So I hoped that this helped you. And just for your information, this little side story, it took about 8 months or so for the IRS to respond to my aunt. So it's a very slow process if you paper mail your return, because you have to do that in order to get your spouse, who is a non-resident alien, a tax identification number. But hope this is helpful. Thanks for watching. Please subscribe. Tell me your stories if you have anything like this, and like, comment, and be awesome. Have a wonderful day.